Good afternoon, everyone, and welcome to today's Space to Grow webinar as part of the University of Essex University Enterprise Zone. Just an introduction to myself. So I'm Josh Clark. I'm the Business Support Coordinator at the University of Essex, so overseeing both the Space to Grow program, which this webinar is part of, and the Angels at Essex investment platform as well. So the Angels at Essex investment platform links investors and entrepreneurs. So if you're interested in finding more about that, if you're an investor interested in investing in innovative businesses, or you're an entrepreneur who looking to raise investment for an innovative business, please do get in touch with us at uez@essex.ac.uk, and we can give you some further details on those. So, as I mentioned, today's session is on angels versus VCs, among other things, as you can see there on the screen. And our expert speaker today is Adam Barron from BDO. And so what I'll do, I'll hand over to Adam for a quick intro. So yeah, hi Adam, and thanks for joining us today.
Thanks very much, Josh, and thank you everyone for joining. As Josh said, my name is Adam Barron. I work at BDO, who I assume most of you will know. We are, depending on who you ask, if you ask most people, we're the 5th largest accountancy firm in the UK. If you ask our marketing department, we are and it's a tongue twister, so you have to bear with me, the largest entrepreneurially focused accountancy firm in the UK. And what our marketing team are really trying to get across is that we do focus on entrepreneurial businesses, entrepreneurial people. We don't really target those big businesses. We like to build relationships with companies and with founders that really want to build something. And that's kind of where my place is at BDO, which is why it's so interesting why our team was put together just over 3 years ago now. I work in a team called Growth Advisory, and our sole focus is helping companies to raise, as the slide says, £2 to £10 million in debt or equity. We do go up to about £15 million, but if you want to talk in stages, it's seed, Series A and Series B in the traditional European sense. We work across all sectors, so the way that our M&A teams work is that they are all sector specific, so we can draw on any of their specific industry knowledge. We're extremely privileged that, for example, our digital health and life science team has extremely strong experience in the field, so they've got a former heart surgeon, a former vet, and a former pharmacist in their team. So if we wanted to we were going to work on a project that would benefit from some of their experience, we'd draw one of them into our projects. But whilst we do work across a broad range of sectors, we are focused on tech. We are a growth team, and that is where you will find the fastest or most obvious growth. So that is where we have the most experience. But as you can imagine nowadays, most things have a tech angle. So retail is now really e-commerce. So that also has a strong tech angle. Okay, so I think that the best place to start is really on the funding landscape. This covers both VCs and angels. And over the last few weeks and months, both me and some of my colleagues have been asked to give presentations on what they say, how to raise money in difficult times, how to navigate difficult COVID landscapes, etc., etc. And over the last few weeks, I think every 3rd or 4th email that I get through my phone says booming time for funding in the UK, record amounts of funding for early stage companies in the UK. And I know that can be disheartening for people that are struggling to raise money. But the numbers really are there, and there's a few reasons for them. So I put up some stats on this slide, and you can see that the main reasons for it is really that COVID has accelerated the ability to connect with investors more. More and more investors are looking to or have the bandwidth to be able to connect with more companies. They're doing more research online. They're spending less time traveling and more time engaging on finding ways to engage with innovative companies. The second reason is is that because of that digital connection, US VCs who used to say, I can't really invest in the UK till I've got feet on the ground in the UK, same for Europe, are now saying, well, if I'm in New York and I want to speak to a company in Boston or the other way around, because of COVID, I'm going to do it online anyway. So what difference does it make if I do that in Europe? And I think once those VCs have done one purely digital deal, they've broken that seal and they don't mind doing it anywhere in the world. So that's another strong advantage. And another reason why Q1 of this year has been such a strong quarter for investment into venture is that this time last year, a lot of VCs and angels held back their cash because they didn't know what was going to go on. They put some more money into their portfolio companies to support them. And then the reason they did that is because they didn't know where their funding was coming from. So the way that VCs work is that they have to get funded by big pension funds or whoever it is. And they were worried that if the economic climate had dropped to such a point that they weren't able to raise any further funds, then they wouldn't be able to either support their own portfolio and make new investments. What they've actually found is that tech's been quite stable in the UK, not just tech, but early stage investing has been quite stable in the UK, which has meant that what we call dry powder, that's effectively the amount of cash that a VC or an angel has sitting there waiting to invest, has only built up over the last year. And to use an odd metaphor, it really is burning a hole in their pocket, because especially from a VC's point of view, they've got their investors sitting there saying, we've given you loads of money, where's our return? Start investing it. And investors are looking for more and more things to invest in. So they're spending more time doing deal origination. They want to do more deals. And that's why a few of the reasons why we've seen a really big boost, especially this quarter, in funding. There are a few other government related initiatives that have also boosted that. They've all been around for a while, but especially things like SEIS and EIS. There's quite a few investors from an angel point of view at the moment who used to invest in property, and this is the same for family offices. And property's kind of been at a standstill for the last number of months, and people aren't so confident in its growth over the next few months. And investors are turning their strategy more to early stage businesses and rather than properties. So there is more and more money coming from loads of different sources into early stage companies. So when you're looking at how to get your business funded, this is where we come on to whether you're looking for an angel or a venture capitalist to come into your business. You have to think of what type of investor do you need for your business. And I was just reading a really interesting article from an investor called Fred Destin, who I don't know if you might have heard of. He's a very well-known name in the VC community. And he was talking about the type of investor that you need and whether you just want a name on your cap table, or whether you want someone to sit there and really help you strategize. And although he's a VC, he was arguing that at a really early stage, the big funds who've got loads of investments don't really have the time or the bandwidth to be able to sit down with each of the individual companies and give them that real strategic help that they need at an early stage. So if you are sitting there and you've got a really great idea, this does happen a lot. To go back to the question with the patents, it happens a lot with companies that have really great technology and really great ideas, but they don't really know how to commercialize it. And it takes that investor to come in who can show them or help them develop a commercial roadmap to really drive it forward and get the returns that both the investor wants and the entrepreneur wants. When you're looking at a VC, there are a few other interesting things that you might want to look at. Is their track record, their sweet spot. So what an investor will not want to see is if they are a Series A investor and you come to them with a seed opportunity. Although you might think if they want to say no, they'll say no anyway. Your issue is that these VCs have massive databases, and if you've just sent out your deck to hundreds of VCs, they all start talking, and it makes you look like you don't know exactly what you want, so you just want money, and it does tarnish your name in the market. Also, when you come back at a later stage when you would be right for them, they've already put black mark next to your name. So I'd really consider quite strongly who you're sending your deck to and why. Fund cycle is quite an interesting one. If you go to an investor at an early stage in their fund cycle, and when I say fund cycle, that's when they've just raised their own funds and started investing in new funds. So right at the beginning of their fund cycle, they could be at a stage where they want to make some safe investments. They usually have a ratio in their portfolios, the amount of risky and safe investments they want to make. So it could be interesting to see where in their fund cycle they are. Could help you with valuation as well. What we've seen sometimes as at the end of a fund cycle, when an investor's got, say, 2 or 3 million left to spend before they can, to invest before they start a new fund, they might give you a better valuation because they know they want to close that fund. So that's a bit of a trick of the trade. If you can find that out, it can be quite a nice negotiating tactic to negotiate with a VC who just wants to do their last deal of a fund. And then also how that investor works with you post-investing. So the difference in styles between angels and VCs. What you'll see is, first of all, is the size. So as you can imagine, the average investment size for an angel is very different to the average investment size for a VC. Different pocket sizes, different risk appetites, etc. An angel, though, is very likely to syndicate funds more, and that either means bring in some of their some of the other people that they usually invest with to create a bigger pot, or for you to say, look, I've already got 10, 15 people that want to come into this round. Do you want to join? And that wouldn't give them any fear. Whereas if you turn around to a VC and said, we've got, we're raising £1 million, we've already raised 100K from one VC, do you want to put 100 in? It's very unlikely that a VC would want to do that, and that's because they've got a stronger focus on their returns, and they know that that's going to get diluted. Their stake in the company is going to get diluted as you move through different rounds, and to be able to keep the stake that they need to be able to, we call it skin in the game, be able to provide that return back to themselves and their investors. Means that they want to have a decent hold on the company. They also want to have enough say in where the company's going strategically. So if they only they won't take a 1 or 2% stake in a company. With angels, as you can, if you go onto the platform that you're probably part of, because you're on this webinar, or a Crowdcube or something like that, they're more the angel focused companies, investments are a bit, on average, more direct to consumer companies, and that's because those types of fundraisers are a bit more emotive. What you'll find quite a lot with angels is they'll invest into a company they find an emotional connection with. It's if you taste something or you see something and you think, I love that, I want to be part of that journey. You think of more, where could this company go, rather than what could my financial returns be on this deal. And then the SEIS and EIS points as well are a lot more, they mean a lot more for an angel investor. As I was saying, on the VC side, VCs are likely to want to have a lot more skin in the game. They've got a lot more responsibilities back to their own investors, so they'll want a board seat because they'll need to have that feedback to their investors. If something does go wrong, their investors will turn around to them and say, they'll have to be able to write reports, explain what went wrong, everything they did, or the board meetings they went to. So they'll need to have that backup for themselves. And for those reasons, VCs will probably come in at a slightly later stage to investors. They'll want to see that bit more of traction. But on the upside is they'll have a much stronger portfolio. If you've got a company, let's say in the retail sector, and they've got a few marketing companies, they could plug in those marketing companies into you. Different ways for those portfolio companies to work together to speed up the traction of your company. So I don't know if there's any questions there while I'm talking.
Yeah, there's a question here, Adam. When considering returns or liquidity, do you look at secondary market as an option? Do you look at a secondary market as an option?
I don't know, Mason, if you want to expand on the type of secondary markets that you're talking about, but we can pick that up as I go through.
Yeah.
There is a, I mean, I can talk about how VCs look at their returns. I think that comes up later. If it doesn't, I can talk about it more in general, but just on the returns point in general, at a very early stage, VCs will want at least a 10 times return on their investment. I know that sounds high, but the point is the riskiest stage of investment that a venture capital investor comes in at, the higher returns they will expect. If you look at it from a point of view that a VC could put £1 million into 10 different investments for a £10 million fund, what they want to ensure is if 9 of those companies don't work out, which is a possibility at such an early stage, then at least one of those companies will return the whole fund and everything else is a bonus on top of that. So that risk to returns ratio drops off as you go up. If you look at venture capital trusts, their returns, we call it envelope, will be about 3 times, which is why you'll hear a lot of VCTs say we look for £1 million of revenue before we invest, because the risk for them has gone down, which means that the returns that they're looking for is also reduced, because if they can get 2.75 to 3 times return on a majority of their investments, then their investors will be happy. Yeah, so this just comes back into a bit of what we've spoken about just before. Like as I said, that those investors look at a 3 to 5 year investment cycle, and they're happy to hold something for up to about 5 years and see that 2.75 to 3 times return. All the different stages are there. So friends and family, pre-seed, seed, Series A, just a few buzzwords really on that slide. Again, I know that I kind of jumped into this, but there are a few different ways that we really look at how you value your company. So the way that our team is set up is we have both advisors and former investors in our team. So we spend a lot of time on valuation before we take a company to market. And what we try and do is we look at how an investor will see an opportunity on the way in and on the way out. So on the way in, an investor will look at comparable transactions to say, for that sector at that stage, what type of multiples on revenue. So I know that obviously that there are companies probably in this presentation at pre-revenue, but if you look at it from a revenue point of view, what type of multiples an investor want on the way in, and then that type of company, what type of multiples on the way out. And then you look at the forecasts and see, does the forecast on the exit multiple give that investor their required return? And for pre-revenue companies, you look at, definitely from a VC point of view, how much equity will an investor want? And what we're seeing is that an investor will want at least 15 to 20%, and this is VCs, and I keep saying investor, but a VC will want about 15 to 20% equity stake in every investment that they make. And then if you're asking for £1 million check, you can kind of crudely work out what your valuation is that way. And I know that's a very crude way of doing it. Whereas with angels, they just want to be a part of the journey. They don't look as much at their equity stake or the valuation. They get excited about the emotion of being part of something they like, and they want to be part of that. Another way, obviously, because valuation is quite a tricky subject at an early stage, is things like convertibles, convertible loan notes that you might have heard of. A lot of people were doing these things about 2-3 years ago. But since the Future Fund came along, it's become a lot more mainstream. What a convertible effectively does is, if you sign up to a convertible loan note with an investor, that money will sit on your balance sheet without a valuation. And the agreement will be that you will get a discount on the next round's valuation. So what it's effectively doing is delaying your valuation until the next round. And at the next round, it is likely that you'll have a bit more traction, you'll have a bit more revenue. So in my opinion, it is a really nice way for entrepreneurs and early stage investors, early stage companies to get a bit of traction before they have to put a value on their company. Just take a second for any questions. Any questions there, Josh? Sorry.
Yeah, I can see one from Phil here. Angels and VCs look for pretty much the same drivers in a prospect company. Can you touch on any of those?
Yeah, Phil, I don't know if you've seen this slideshow before, but that is the next slide. Okay, so yeah, as I said, what we call it the equity story. So you're right, both angels and VCs will look for exactly the same drivers, and I'm just going to read off a few of them and explain a bit more on these. So every single investor will want to know that there's a big market. If you turn around and you say, look, this market is great, I'm the only person working in this market, any investor's going to turn around and say, is the market not big enough? You're never going to get 100% of a market. So if you say, look, the max, we're going to get a 10% slice of this market, then you need to know that market's big enough to be able to get the returns that you're looking for. Whenever you speak to an early stage seed VC, what they will say is they need at least a minimum of £1 billion market. If you take 10% of that, then you can work out, going all the way back to what I was saying on the previous slide, how they work out their 10 to 30 times return, because you work back from £1 billion. Is that market growing? It really hits home in COVID. What people are going to look at is people are avoiding, investors are they're coming back to it now, but the leisure high street retail market, investors are still a bit cautious about it because they want to make sure that drive is going to go back and that market is growing again. So yeah, market, first thing investor will look at. Second thing is management team. So you can have the biggest market in the world, you can have a really good proposition, but if you don't have the right management team to take advantage of that opportunity gap, then investors just won't be interested. Well, they like a lot of VCs that we talk to like to see members of the management team that have been there, done that before. It is very rare to find something like that, which is why investors ask for it. I don't know if you saw Kazoo. Kazoo became one of the fastest growing UK unicorns, and that was for a very, very simple reason. One of the management team of Kazoo had previously built Love Film and Zoopla. So when he said, I'm raising money, everyone threw their money at him. And there's a bit of a backstory to that, is that it wasn't everyone threw their money at him, it was anyone who he asked to invested. it was a bit of a closed shop. So their track to become a unicorn is that it was the management team and the market. Everyone needs a car. This guy's done it before. Platform, you can have a really, really good opportunity, but once you start bringing in clients to your platform, how do you upsell to them? It's not just about spending money acquiring customers and then just selling them a subscription for £10 a year. Once you've got them, do you have something which you can sell more to them on? Is it a sticky platform? Is it scalable? Can it go internationally? Where does it work? As I said, when I was talking about the market, on competition, it's good. It is really good to have competition. And I see a lot of decks that just say, yeah, we've got no competition. Well, if you've got no competition, you are going to start raising eyebrows as to why don't you have competition? If it's such a gap in the market, why is no one else competing with you? Even if it is a DIY option, why is no one doing it? And what we say quite a lot is there's like an 80-20 rule. If you are offering something which is definitely solving a problem in the market, but it's costing too much, does the company who offers a competitive product which only offers 80% of what you're doing at half the price, will the customer want to pay that extra just for that extra 20%? If you are revenue and cash generative, this is where mainly VCs really make their money. They really like to get into the quality of earnings, so your margins. They'll benchmark you against your competition, your sector, how quickly you're spending cash, etc. One thing to avoid when you're talking to, especially institutional venture capitals, VCs, is spending money. What investors want to see is that you take a really considered approach to how much money do you need and where are you going to invest it. And investors don't want to hear you say spend, because it makes you sound like you're just trying to do something with the money that they're giving you. There needs to be a plan of action for every pound that the investor gives you. So this just shows the elements of how we build that story for an investor. So right at the top, you've got the investor story, but the building blocks underneath it is really what support that story. Anyone can put together a flashy PowerPoint presentation. I've even managed to put this together. So it's easy to put a flashy PowerPoint presentation together and show a VC and sell them the dream. They're going to start digging down into what supports that story. So as we've spoken about before, does the investor profile that you're going to support the story? Do your forecasts support the story? If you've got customers, business systems, due diligence, they're going to go through all of those things to see if they support the story. And this is, as I said, looking at forecasts, anyone can, I'm sure you've all heard the phrase hockey stick. Anyone can put together a set of forecasts that shows that you're going to be the next Uber. And that is something that any investor probably doesn't want to hear. If you say things like, well, Facebook did it, well, Uber did it, well, we're going to be the next Zoom or whatever it is. You need to balance that ambition with realism. Yes, it's great to have that ambition to be that next unicorn, but how are you going to get there? What investors want to see is that three statement financial forecast, which is your P&L, cash flow, and balance sheet. If you can show that the P&L is growing year on year to support your year 5 assumptions of where you think you can exit, it also needs to flow through to the cash flow and balance sheet to show that the company is built for the purpose of when are you going to run out of money? When do you need more money? When is your cash flow point? When might you raise again? These are all things that investors are going to want to look into. KPIs are also really important. What are you benchmarking your company against? If an investor every 3 months is coming to you and saying, how are things going? Anyone can say, yeah, great, we're increasing our revenue, but are your margins dropping? Is your marketing cost per revenue dropping? Is your headcount per revenue increasing, decreasing? All these types of things. So when you've got this financial model, which is a 3-statement model, hopefully, investors will also want to make sure that it's dynamic. And by dynamic, it means there's no real hard coding in the model. They'll want to change sensitivities in terms of how quickly you invest money, how quickly you're taking on new sales staff, you're growing abroad, your margins. Investors will sensitize these things, and that also flows through to when they're doing their valuation analysis. If you turn around and say, look, our revenue figure is going to be 100 million in 5 years' time, I can guarantee that when they're doing their valuation analysis, they're not looking at that 100 million. They'll discount it by at least 30%. And they'll look at the different inputs and assumptions that you've used and try and bring down that ambition to say, if they don't hit that, how safe is my investment? Customer insights, really important, and this comes back to product market fit, which investors are really, really hot on. So how well do you know your customers, and how are you shaping the business based on what your customers are feeding back? So if an investor's turned around and wants to do some customer due diligence, they'll turn around and find out how sticky the product is, how well you've reacted to what your customers are asking for. How are you doing for time, Josh? Yeah, good. All right, cool. So yeah, I think that there's a little bit of a real summary here. So questions that you need to ask yourself when you're going out for investment, and this is what we always advise people, is when they're going through their deck before they send it out to investors, there's a bit of a sense check to say, so what, and try and answer the question before a VC is going to, well, not just a VC, sorry, a VC or an angel, any investor is going to ask it. So is the market going to restrict the growth? And that is the market big enough? A few different things that we came back to on those building blocks are all on this slide. So how do you approach investors? There are a few different things. Talk while you're reading the slide, but warm introductions are always helpful, of course. Some of the VCs that we speak to see 4,000 opportunities in 12 months. For a team of 4 people, they need to have a look at each deck, run their portfolio, make the investments. It's really, really difficult. So there are a lot of investors that will only take warm introductions. A lot of investors actually at the moment are saying they don't want to take warm introductions. They've got a form on their website for you to fill in. But there's always ways that you can try and find a connection to VCs. I know that there's a fund. There's actually 2 different funds that I know at the moment. One's called Ascension and one's called Playfair Capital, that run founders evenings. If you just join one of those, try and make yourself heard. Make sure that when they see your deck or they see your name, it perks their interest and they want to read more. It was always a lot easier when you could just go to coffee evenings and you know an investor would be there. You can try and make that introduction. But if there's a way that you can try find those warm introductions, then it's always helpful. Anything going to these award ceremonies, incubators, angel networks, they all help. Just try and make sure that what you're doing is focused. So if you are going to angel networks, don't sign up to 5 or 6 of them. Every angel network as Josh and John will know, is there that serves a different purpose. They serve a different purpose because they know that the angels that are investing in the companies that are showing them have a different type of investment criteria. We know some angel networks that don't like deep tech because their investors don't get it. And we know some angel networks that only like deep tech because their investors find it gives them a bit of support on their risk appetite. So different places for different companies. So hopefully you will get term sheets once you go out. Loads of different things that you need to look for in a term sheet. It's probably a whole different seminar or webinar in itself, but things like drag rights, bad leave provisions. I'm going to caveat this with while I'm a qualified lawyer, and I wouldn't look at a term sheet and give it my legal opinion. Make sure you've got a good lawyer on board. What's great at the moment is a lot of lawyers are happy to help companies at an earlier stage. Places like Seed Legals are great, but you can also go onto websites like Cooley Go, who give you a lot of free information. Really read up on it. Approach some big name law firms. A lot of them are doing seed rounds for £4,000 or £5,000 at the moment to build that relationship at an early stage. So you never know that they might buy into the idea and want to work with you, and that'd be really great. If you've got a good legal setup at the beginning, it helps you going forward, and it also helps attract investors at a later stage. What we are seeing a lot of at the moment is downside protection. Investors are coming in at an earlier stage because everything's getting more and more competitive at the moment. What COVID has really done to the investment landscape it's not what people thought it would do, and has reduced valuations. And the reason for that is because investors are taking less risk, which means the companies that they deem investable are a lot hotter, which means a lot more investors want to invest in them, which has actually increased valuation. But it means that investors that used to invest at a later stage are coming in an earlier stage, and it's not really where they're comfortable. So they're looking to get a bit more downside protection. So where we used to see things like 1x liquidation multiples, we're now seeing 1.5, 2x liquidation multiples. We're also seeing liquidation preferences, which is where investors up to a certain point will get their money back. After that point, they'll get their money back and the value of their equity. Loads of different things, loads of different ways that investors try and protect their downside. What I will say is the more ways that investors try to protect their downside, the more benefit that gives you for the upside. So that means that you can push the valuation higher, knowing that the investor that's coming in is getting that downside protection. So rough deal timetable on here, it is a bit template. What you work backwards, what we'll say is once you go into exclusivity with an investor, for them to do all of their due diligence takes about 2 months. An investor can decide really if they're going to invest in a company within 6 weeks. It doesn't take as long for an angel. An angel can make a decision overnight. So when do you require the money, and also comes into the type of investor that you could be looking for. And that could also mean whether you're doing a bridge round, which means just a round to get you to the next stage, or if you're doing a full round. Types of due diligence that an investor will want to do is the financial due diligence. They'll go through your model. They make sure those assumptions all have relative or proper proxies that they can support. If you show them something and you can say, look, we know this is the margins that we're going to put into our model because this is a contract we already have in place, those types of things will only support the investment that you're doing. Legal, commercial, technical, all types of due diligence that an investor will want to do. So why would you not just go on Dragon's Den? For a number of reasons, and based on a few companies that I've seen get investment from Dragon's Den the last couple of weeks that we've actually met with or seen over the last year or two, I can actually say that risk factor is the main one. I've seen a lot of companies that have got investment on Dragon's Den that I can only imagine the reason they've got investment is for the TV drama. Some of these companies have spent a year, 18 months trying to raise money before, and they've had no luck. So yeah, so some of the dragons can help you along the way, but in the long and short of it really is that these dragons have really, really big portfolios. They put bread on the water. If you get a charismatic management team with a big market and someone who's worth a few £100 million puts 20, 30, 40,000 pounds into your company, it doesn't mean that much to them, but it means a lot to you. So I'd really try and find it, if you're going for an angel investment, someone who can really help you drive the company forward, than someone who's trying to do it for TV ratings. So in summary, get the story right, make sure those building blocks are in place, make sure you know the type of investor you're going to and why you're going to that investor. Make it obvious in your email to them or your outreach to them. Don't just do a blanket generic email. Explain why. We always find it's helpful if you're going out to an investor, you say, I think you might be interested in this opportunity due to the investments you've made in X, Y, and Z, that type of thing. Or we think you'd be a really strong partner for our company because of the way that you supported X, Y, and Z, those types of things. Make sure your forecasts are realistic, but they still need to be ambitious. Investors still need to be confident they're going to give them the returns that they're requiring. Any evidence that you can have to meet the challenges that you're going to come up against comes back into COVID, but also into the management team. Investors right now are going to look at the last year and say, what have been the struggles for this company in the last year? How have management dealt with them? Did they manage to pivot and help the company survive, change direction to cope with what's going on around them? And yeah, anticipate those due diligence exercises. So if you already have a data room built when you go out for funding and you can say, here's my data room, it's open, we're ready, we're prepared, it's only going to support your investment case. It's going to make you stand out as a credible management team, but also as a company that's well prepared for a fundraise, but not just for a fundraise, but also to grow. So yeah, that is mainly it. I think we're just okay for time. So I think if we have a Q&As, Josh.
Yeah, perfect. Thanks for that, Adam. I know that John wanted to make a comment on some of the questions that are asked, so I'll pass over to John now.
Yes, thank you, Josh, and thank you, Adam. And it's very illuminating as you go through this. I just want to answer a couple of the questions, but first, a question for Adam. The pros and cons of consulting services, manufacturing and IP licensing, they all carry different risks when you're working on these kind of businesses. And is there any sort of indication on current investment trends, whether people are more interested in investing in manufacturing or whether it's mainly services like SaaS or, you know, those kind of areas? And we had a question very early on about IP, and I'd just like to mention that we've got an IP webinar next week on May the 4th, and it's well worth listening to. We're doing that in conjunction with the Intellectual Property Office, and we will be following that up 3 weeks later with an IP debate where people will be able to actually put their ideas to a panel of IP experts dragged in from across the industry. So there's a couple of areas there. But moving on from the IP, is there any indication that people are investing more in manufacturing, or is it all SaaS services and digital?
So I think broadly it comes down to picking the investment or the person that you go to for an investment. If you are talking about, let's say, the VC community at large, currently there is a lot more drive for B2C, so for B2B SaaS investments, and that is because of the risk appetite of investors. At the moment, they are taking less risk because of what's happened in the last year. People don't really know what's going to happen in the next few months, but the thing that has really stood up in the last year is B2C investments, B2B software companies, and an investor's risk appetite just means over the next few months that if something does pop up again, if there's another variant, etc., then that is something that will stand up a bit more. The reason that I'm stuttering a little bit is like I don't want people to think that if they've got a manufacturing company or an IP-rich company or a B2C company, that makes your investment or your investability any less. It just means you might need to spend a bit more time focusing on the investor that you go to. For example, if you've got a manufacturing company, there's a fund called the IP Group who only invest in manufacturing and IP-rich companies. So it just means spending a bit more time and not just throwing out your debt to more people.
Thank you, Adam. And I'll answer the question. I will answer the question from Mason regarding secondary market as an option. The secondary market is a growing market now where VC funds or fund managers will actually buy out original investments, buy out original investors. So in other words, you can, as an investor, you can lessen your risk. In other words, you can step out earlier than you originally planned. And that's actually links to that are available in our resource library on our Angels at Essex platform. So any investor or entrepreneur can find out more information about that in our resource library. But for those of you who aren't registered on our platform, then I do recommend that you take a look at that, because it can help influence investors if they know that they haven't got a really long-term commitment. They can opt out of your deal as you're going ahead.
Just on, I think what we, in the UK, what we call cash out or secondary, the later in a company's commercial traction or financial traction, you'll see a bit more cash out. Especially, again, I know that the COVID's kind of changed that in that with this decreasing risk appetite for investors, they'll want to make sure that the management teams are bought in and have skin in the game in the company. So they're a bit more reticent to give management teams cash out until a bit later in the deal. If you are an early stage investor into a company, what you will actually find is that if you've invested at a seed point or a seed stage, some of the US investors might try to take you out just because they want to take more of the company. And if the company only needs, let's say, 10 million, and they might want to put 13 or 14 million into the company, they might look to buy out some of the early stage investors. But in terms of giving cash out to management teams, that's happening later and later in the investment cycle at the moment.
Thank you, Adam. Very comprehensive. Almost reminds me of some football clubs I remember. And there was a technical question here about the Sustainable Development Goals. Now, Sustainable Development Goals are recognised throughout the world, and Europe actually leads the way in Sustainable Development Goals, but they have taken a big, massive hit due to COVID. And yes, all countries need to strengthen the resilience of their health systems and their prevention programs and that sort of thing. But when it comes down to at our kind of level, we tend to focus more on net zero, on the carbon emissions, more sustainable growth in the industries that we have to be able to protect the environment going forward that way. So whilst, yes, the health aspect is very, very important, and we can't stress that enough, there are other aspects to the climate control and what have you that we're currently experiencing. And I think as a platform, we don't focus on that directly. It's not one of our strengths, but we are seeing more and more businesses coming onto our platform with climate related or sustainable goals related activities. And I see more of that in the future. And certainly the industrial strategy, which the government has released, is very much focused on net zero. And we've got a lot of net zero activity going on generally. And yes, we will see more of that. There are lots of investment funds which are specifically targeted at that. And our nearest one, of course, is the low carbon fund that we have, which is operated in the east of England by the Norwich University. And we've got direct links and ties to that. And I think we have actually answered all the questions that were sent to us. And I believe that this is now coming to the end of our presentation. Josh, would you like to do the closure for me, please?
Yeah, thanks, John. Yeah, no more questions that we have there. So yeah, thanks everyone for coming again. And a very big thank you to Adam for presenting today. You can see Adam's got his contact details on the screen there to link in with him, or drop in an email if you've got any more questions. Or of course, you can email us at uez@essex.ac.uk as well. If you want to find out more about our Space to Grow events or the Angels at Essex platform, please do drop us an email there, or you can find more information on our web pages as well. So for now, thanks everyone for coming, and enjoy the rest of your afternoon.